Good afternoon. I'm Susan Weber, and joining Walker & Dunlop CEO Willy Walker today are three WDers, Ivy Zelman, Kris Mikkelsen, and Aaron Appel, who will do a deep dive on the state of commercial real estate. Thank you for joining us today, and now over to Willy.
Thank you, Susan, for that quick intro. I don't think my three colleagues really need any introduction to people who are followers of the Walker Webcast, but really quickly, Ivy Zelman, who runs Zelman Inc., which is part of Walker & Dunlop and is renowned as one of the most insightful analysts and researchers on both the single family as well as the multifamily housing markets. Aaron Appel, who runs our New York City capital markets group and is renowned as one of the very best finance professionals in the commercial real estate industry, and Kris Mikkelsen, who runs Walker & Dunlop's investment sales group, which has grown dramatically over the past several years and has really taken a market leadership role in the multifamily investment sales space. It is a true pleasure to have the three of you back with me. I thought no more appropriate time than the day that there is an FOMC meeting, which I think most pundits are predicting a 50 basis point increase in the Fed funds rate. But given all the moving parts in the market, getting all three of yours perspectives on what we are seeing, how people are making sense of it, and how people are making money in the midst of all of it is obviously why so many people have signed up to listen to us today. Let me back up a little bit to our last discussion. Aaron, you were, I asked if you had $100 million, where would you put it? And Aaron said he would be buying Bitcoin. I think Bitcoin is down 50% since you said that, Aaron. So good call there. Ivy, you were rehabbing older single family properties, which I think continues to be a really attractive space given where the single family market is. And Kris, you were looking for age targeted multifamily and focusing on the build for rent market. So let's get to today, and given those predictions, get a sense of where all of your heads are on where to be investing today and what has changed since those comments 5 or 6 months ago. Aaron, let me start with you as it relates to your outlook on the market and what you're seeing right now.
Yeah, look, there's been a bit of a disruption in the marketplace based on the fact that treasury indexes have basically doubled in the last 6 to 8 weeks. The lowest cost of fixed rate, 10-year money, which is sort of the down the fairway capital that long-term investors look to borrow, is somewhere in the low to mid 4% range. Where the majority of it is sitting in around the 5% range. That's up from 2.5%, 2.75%, even the low 2% range in the call it in the summer of 2020. So there's been basically a doubling of the borrowing cost for the two hottest asset classes being still multifamily and industrial. The pricing on office assets also in the public markets was down in that upper 2% range, and we've seen that move as high as the mid 5% range in the securitized markets, if not even 6% for certain assets. And then we've seen disruptions in the floating rate markets, primarily driven by the disruptions in the bond markets. Where we've seen bond buyers push back on buying floating rate bonds at certain credit spreads, and they're looking for more yield based on where the forward SOFR curve is, and just also what they view to be a higher risk investment today. So the capital markets, the cost of funds has increased substantially. There's a lot of talk of illiquidity. I don't think there's a lack of liquidity. I just think that it's a tough pill for a lot of sponsors to swallow, to see the cost of their funding, come close to doubling in such a short period of time. And, we've seen a pause on certain types of transactions or larger scale transactions that were out in the market for fixed rate financing have been pulled back, and people are sort of waiting to see how this plays out. But I do think that the days of seeing, 3% fixed rate money are gone. I think that we're not going to see those again for a very, very long time. If we do, there'll have been some other black swan event that took place, and inflation would be at 40% at that point. So I don't think we're going to see that. I do think we'll hopefully find some stability in the marketplace as people adjust to where rates are, and hopefully we've seen some stability in where treasury rates are. On the floating rate side, there's a lot of pressure on the forward SOFR curves. Cap costs have doubled, if not tripled. We've seen cap costs on transactions which used to cost 10 or 15 basis points of the loan amount now cost anywhere from, we've seen as high as 2%. That's come in a bit. We're seeing it somewhere between 1% and 2% today to purchase a SOFR cap. And we've seen some credit spreads widen out, certainly in the market base from lenders that rely on leverage. So either accessing the CLO market or using warehouse or repurchase agreements to fund their loans. Those lines have also been priced out to coincide with the widening out in the CLO market. So borrowing costs are up. On the asset side, I would say that, there's still strength we're seeing in the multifamily market. We're still seeing the same rent growth story. We're still seeing the capital flow into that market, same in the industrial space. We've seen a little bit of a step back in the office space, I think. The country is fully open at this point, and there's still a lot of companies that aren't back in the office or have moved to permanent hybrid work from home and work in the office models. So we've seen, continued, slowness in that segment. If you ask me what I thought the best opportunity was to invest in right now on a risk-adjusted return standpoint, if you want to make a big bet, I do think that, in the right cities, urban infill hotels, there's been a huge reduction in supply. And I think there's a big play in that space where someone can really outperform the market and get into assets at a very, very low basis with, in my opinion, tremendous upside.
And Aaron, before I move to Ivy, I'm going to come to you in a second, Ivy, on the rate move that he just underscored and its impact on the commercial space, and get you to give us your view on housing. But Aaron, you mentioned things have settled down a little bit as it relates to cap costs. When I had Peter Linneman on a couple of weeks ago, I asked Peter, isn't it the transition? Isn't it getting through these moves that's so difficult? And Linneman kind of shrugged his shoulders and said, markets adapt. Are you seeing things settle down a little bit with the change from everyone thinking that the Fed was going to raise by 25 basis points to then basically everyone saying today they're going to do 50 basis points, that's allowed people to price forward a little bit better and make it so that those cap costs have come in a little bit?
Well, I think the weakening in the stock market and what we've seen in public equity markets, and so many names down, 50 to as high as 95% in the NASDAQ, and then in the S&P and in the Dow, we've seen, companies down anywhere from 15 to, as much as 40, 50%, including some of the real estate service firms, whose income has been on fire the last 12 to 18 months, and strong earnings reports. I think that that has brought about a theology that the Fed is not going to be able to push rates as aggressively to combat inflation, because it's just going to break too many things in the market, and we'll wind up in a recession, even though employment is at an all-time high, and continues to outperform anything we've ever seen, or the tightness in the labor markets. There's a thought that at some point we're going to wind back up in a recession, and therefore they're not going to be able to accelerate rates. I am a little bit skittish on that, because I think that the market is used to, and certainly in my lifetime and certainly career that I've been following the capital markets, the financial markets, they have been able to put in this Fed put, so to speak, into the marketplace where at some point when there's enough distress, they come in, they cut rates, they start quantitative easing, they flood the market with capital, they buy securities, they buy bonds, and away we go again. But we've never been in an inflationary environment before, and we have extraordinarily high inflation. And the only way to really to slow the inflation is to aggressively pump rates. And they sort of have a choice to make. Do they protect the assets and the capital markets and the wealth, or do they fight the inflation, which, candidly, half the country doesn't have assets to protect, so they don't care. They only care about the inflationary factor. And I am of the mindset that they're going to do whatever they can to fight the inflation, because it's going to, it'll cripple the country otherwise. So, if that's the case, you could see rates far in excess on the federal funds rate than what people are even projecting. The only thing that gives me question on that is we have such a huge amount of debt. Really, the only way for the country to get out of that debt is to continue to inflate. So it's a real problem. I'm happy I don't work for the Fed, and I'm happy that I don't have to make those tough decisions.
Paul Tudor Jones yesterday said he would not want to be in Jerome Powell's shoes. Ivy, let's talk about whether this rate move has put any kind of downward pressure on the single family housing market as it relates to value appreciation and activity.
Well, overall, I'd say that with this being the spring selling season, what we've seen in the last few months is seasonally slower than what you'd expect on a seasonally adjusted basis. Pending home sales have been down for the last several months, seasonally adjusted in the existing market. The new home market, which is a little bit more complex, Willie, because you have about half of the communities that are open for sale. Builders have been forced to limit sales, and they're doing so because of their backlogs that are so extended. The backlog of single family homes right now is back to November 2006 highs. And you've got about a third of that that's speculative. So there's significant cost inflation. There's labor constraints. There's municipality delays. So it's very hard to read whether or not demand is, again, moderating, or is it a function of the sales being limited? But I would say in the last 30 days, things have changed dramatically. I do think that we're seeing moderation. It's gone from what had been a frenzy and, waiting lists that, the first person on the waiting list would be ready to buy, to something now that's a little bit, I've got to go a little deeper in that waiting list. There are buyers that are having difficulty qualifying. So we're seeing an inflection point. And it's going to be interesting to see how the market digests the inventory when it comes to fruition. With all of these delays, the builders are very frustrated, rightfully so, in getting these homes completed. But we know that the monthly payment for the consumer, with rates where they are today and home prices continuing to increase, builders are still raising prices, not across the board, but we are seeing sequentially prices increasing anywhere from 1% to 5%. And right now, annualized home prices are running up in the mid to high teens. And you see cities where on a 2-year stack basis, home price appreciation is up more than 30%, but the monthly payment for the entry-level buyer is up more than 40 to 50%, or in the 40 to 50% range. So, affordability is definitely stretched. And I think that that's going to challenge that first-time buyer to continue to enter the market.
And as a result of that gap between home ownership and the cost of renting, does that keep you bullish on either the single family rental market or the rental market writ large?
Well, I think that we've got from both the rent inflation in the multifamily market is very excessive. And we see that whether we look nationally on a blended basis, according to our proprietary surveys, we're running on a seasonally adjusted basis about 8%. That's blended. If you look at new move-in, we're hearing, double-digit increases. It feels not sustainable. On the build for rent side, you still have a lot of capital chasing that asset class, announcements that are continuing even as of this week, more capital flowing into that space. And I think that that becomes a competitor to the multifamily backlog that, we could debate when that backlog will get delivered, but the backlog, delays are real and it's problematic. The best incentive for these developers economically is to get these projects developed and completed. And as those projects get developed and completed, with it at a multi-decade high, I think you're going to see some pressure on lease rates. I don't think they're sustainable. Historically, if a multifamily operator was to get 4% rent growth, he was doing cartwheels. And, we're historically in a 2 to 4% range. And right now, Kris and I are talking, you're talking upwards 17+% and north of that in certain markets on, what would be market rent today. So I'm concerned that that's just not sustainable. And I know that the single family rental market is not yet plentiful enough in terms of new construction to really see whether or not how that performs competitively with the for sale product. But I do think that we've got that supply that will potentially be a competitor to the multifamily supply that's in the Sunbelt markets and in the more suburban areas because of the whole phenomena of remote work and people wanting that space and distance.
So before I move to Kris, just one follow-up on that, Ivy, which is just this, the timing, we're clearly seeing in the multifamily space today exactly what you just said, which is rent growth that is at historic highs and no real competitive, if you will, threat to downward pressure on those rent increases because of the lack of supply on the single family side, lack of supply on BFR, SFR, and then also a lagging new inventory of multifamily development that was slowed down through the pandemic that isn't delivering today. And yet with that as the backdrop, in the past 2 weeks, most of the large multifamily publicly traded REITs have sold off dramatically. Do you think it's just that forward look that you just outlined as it relates to these aren't sustainable, or is there something else going on in the market today that has had that downward pressure on the multifamily REITs?
I think Kris can speak more to it from, his vantage point, but I think you've got a disconnect between what sellers are expecting and what buyers are willing to pay on a risk-adjusted basis now. And valuations are definitely at very high levels, record generational levels. And so I think you're seeing that spread widening between buyers' willingness to pay what these sellers are looking for. And so that could be anticipating value corrections that the market is anticipating, despite the fact that the fundamentals today are so strong. We had a lot of liquidity pumped into the market. There's a lot of capital that's been chasing the resi asset class, whether we're talking for sale or for rent. This has been, as I like to say, the prettiest girl at the dance, and everybody wants to be in what has been hard assets in the resi space. So I think there's this expectation that the valuations are going to be under pressure without even yet seeing the supply come to market, just seeing what's going on right now, real time. And I think that's a good segue to Kris.
Yeah. Kris, is the market getting it wrong? Or are you actually that delta between the bid ask that Ivy just said is out there? Are you seeing that?
Well, first I'll address your REIT commentary, and yes, they've corrected and they sold off 10 to 12%, and that was after a 35 to 40+% run in the 11 months and 2 weeks that preceded the correction. So let's all just take a bit of a deep breath and acknowledge what we've experienced over the course of the last 6 to 9 months in terms of valuation run-ups. I would go back to answer your original question with what you would be buying. I'd be putting capital in assets where you can reset rates as quickly as possible when you're in a 7 to 9% inflationary environment. And, on top of that, I would continue to put capital in markets that have strong growth fundamentals and low regulatory risk. And I think that's really kind of what we're seeing play out real time in the assets that we're working on all across the country. Returns in large part were pretty much homogenized over the course of the last 12 to 18 months. We talked 6 months ago about where we saw weakness and where we saw concern, and Aaron and I both pointed to deeper value add, deeper workforce, older vintage housing that was pricing on the margins of replacement costs, that was potentially stressing affordability of that resident base. 6 months ago, those assets were being acquired at total returns that looked pretty similar to levered core and core plus opportunities. We are decoupling away from that, and frankly, I think that's healthy, and I think the market is getting that correct. But in the same vein that you see some of that decoupling, you have to acknowledge the amount of liquidity that's in the space, number one, and the growth that we're seeing, number two. Those two factors inform cap rates much more so than the third factor, which is the cost of debt. So when we look at high growth markets that are high on the growth and resiliency scale, high on the asset quality scale, we've seen little to no impact on valuation. If you start to sacrifice a little bit on the growth and resiliency story in the market that you're in, if you sacrifice a little bit in the asset quality, then you might be relegated into kind of what I call the bottom right hand and top left hand quadrant of that scale. And we have seen some pricing correction there, and that's largely a math exercise with buyers that are trying to deliver the same levered return today with slightly lower leverage levels and an increased cost of capital. And so if we've seen 4 to 6 or 5 to 7% corrections there, that's a fair comment. I would point to, just like your multifamily REIT sell-off, what are we correcting from? And I would position that in the beginning of November, when we were on this call last, we saw another 7 to 8% run in values, particularly in the first 60 to 75 days of 2022. And I think that was largely related to two factors. I think the first is we had a real scarcity effect in the market because so much was pulled out of 2022 into the fourth quarter of 2021. There wasn't a lot of inventory on the market at a time where there was still a tremendous amount of liquidity. And then number two, and I think you saw some revisions from public REITs, in particular Sunbelt oriented REITs, where they were revising up expectations because the normal seasonality that I think we all expected to see in November, December, January, and February really didn't materialize. The strength in fundamentals continued, the wind kind of remained at the sails. And I think those two things really kind of put another leg up on pricing through the middle of March that we've probably given up a little bit since we've seen rates run. And it's like I made a lot of comments in the fourth quarter of the year last year. I said that the power is in the hands of the person with the product. And I think we should revise that today and say that the power is in the hands of the person with the cash, because we are finally seeing a differentiation in our bidding pools and a strong preference towards those lower levered, unlevered IRR kind of higher quality buyers, where they are getting some preferential treatment and they're able to take advantage of the positioning of the market.
Aaron, to Kris's point, as it relates to lower leverage or cash buyers, when people are coming to you and your group these days to finance properties, are they basically underwriting rent growth that grows faster than interest rates are going to move and therefore going floating rate? Or are they basically saying, if I can grab a 4.75 coupon today and fix it for the next 10 years, I'm fixing?
Yeah, so I think, look, it depends on who the buyer is. I mean, we have a client that's managing an account for a top 2 state pension fund, and we're in the market to go out and find them a 5 or 7 year fixed rate loan at 40% leverage. So that's one type of buyer. But a lot of buyers, are looking to put in 35 to 30 or 25% equity into a transaction and borrow at, moderate to, relatively high leverage. To us, that's not high leverage, but to some it may be. That buyer in the multifamily and in the industrial space, because the cap rates are so low, really hasn't been doing any fixed rate borrowing at all, because the debt coverage ratios are not there. They weren't there when rates were at 3.25%, and they're certainly not there when rates are in the mid 4% range. So that's been purely a floating rate buyer. And that buyer, we were originally, I would tell you, last time we talked, we were in the market, we would go out and we'd find liquidity at 75 or 80% loan to purchase price, and that would price somewhere in the mid 2s over SOFR or LIBOR at the time to upper 2s. And that bid is now, 70% leverage, maximum leverage. And that pricing is in the high 2s to low 300s over SOFR. So there's been a shift, and there's been a difference in the leverage one can get on these lower cap rate deals, and the cost of the financing is a little bit more expensive.
I think Aaron's point on the cost of caps is a very good one. I would say, just based on the bidding activity that we've seen and the what types of financing buyers are pursuing. I've actually seen a little bit of a shift back towards fixed rate in the last 2 to 3 weeks because of those cost to caps and the acknowledgement of how long it will take to get out of that negative leverage situation when you've got 20+% growth on trade outs. You heard from, again, a lot of those multifamily REITs that reported last week, consistent renewal increases in the mid to upper teens. And so I feel like there's been actually a little bit of a shift back towards accepting, hey, it's going to be at a lower leverage point that I'm going to be able to fix for the next 5, 7, 10 years. And if I'm in a 7 or 8% inflationary environment, a 4.5% cost of capital doesn't seem like a bad trade.
So we've talked, a lot of buyers have come to us. We had a client acquiring 2 multifamily assets in Manhattan, operator with an institutional partner. And, we went out to look for floating rate financing for them, and they came to us, and at the last minute and said, hey, we want to do a fixed rate loan. We're terrified that rates are going to continue to rise and run up. And, ultimately we're doing a floating rate loan because the leverage that they were looking to borrow at wasn't available in the market on a fixed rate basis. The loan sized on a floating rate basis, which is predicated on where your cash flow will be 3 or 4 years from closing, versus a fixed rate loan whose amount is predicated on where the cash flow is today. So that fixed rate loan was 47 or 48% leverage. And the floating rate loan, you were able to get to 65 or 70%. But, Kris and I were talking yesterday about this, and even this morning with you, Willie, buyers of real estate in the industrial and multifamily space for the last 2 years have seen, outsized returns for core type purchases, core plus type purchases, value add purchases, and even development purchases. They've seen equity multiples that are substantially higher than the historical norms. And they've seen IRRs that are, in the triple digits potentially sometimes. And they've seen that because the cost of debt has been incredibly inexpensive, and they've been selling into low 3 cap markets or even sub 3 cap in certain situations. So the increase in rents in rates today are high, and they're tough for people to swallow. But at the same time, Kris made a good point. He said, look, you're now the cap rates can stay the same potentially because the rent growth has been so substantial, and the forward projected rent growth is high enough that one can still afford to pay that same cap rate. The cap rate shouldn't move. Just, your returns that you're now going to get are normalized to where historically they've been for that risk you're taking in the marketplace.
It's interesting.
Go ahead, Ivy.
Because the consumer right now who's a buyer, the mortgage market is seeing a tremendous rush for people to lock in. And we're also seeing a shift to ARMs. And, applications for ARMs have more than doubled, although they're still below historic levels, significantly below historic levels. But, on the flip side, you're mentioning people are looking for more fixed. The consumer is adjusting to the higher rates by looking for an ARM, and they're still below, call it 10%, but it's definitely a shift that we're seeing in the market for the consumer. And builders, because they tend to release the product you've got later in the construction cycle. So you typically get locks, are anywhere 45 to 60 days. On the resale side, it's probably 45 days or even less. But I think that there's a lot of people that are, being re-underwritten to see if they can afford. And there are, debt levels, and especially affordable buyers that have debt to capital ratios that are in excess of 50%, and it's getting very difficult. But the offset for those buyers, those primary buyers, is there's still a tremendous amount of investors in the market, both private and institutional, that continue to be incremental buyers. We did see a few markets where some private investors are starting to show some concern and might be canceling in some of the mountain states, even some pricing pressure. But that's maybe right now the beginnings of what might be on the horizon, where markets have been up more than 50% on a 2-year stack basis. But there's so much cash buying in the market too. 2-year stack cash is up over 60%. And the wealth creation, we've seen tremendous wealth creation. But then again, what's going on in the stock market is eroding wealth. So we've got a yin yang, and I think that people are starting to reconsider, the investors, of what kind of returns they're going to get whether they're Airbnb-ing it or looking for renters, but there's a lot of angst in the market right now, and mortgage markets are in quite a bit of disarray. We're seeing spreads that have really blown out, and there's concern about, the Fed has got obviously $9 trillion on balance sheet and their portfolio, and whether they're not selling MBS or they're just not going to continue to buy on new origination. I think we're definitely concerned about how much of that investor activity will sustain the level of demand that has been definitely influential on overall on market activity.
But I mean, even in a world where the Fed over tightens and the investor buyer moves from the market, we're in an environment where the cost of home ownership is up 50%, even more than that in certain markets across the country over the course of the last 12 to 18 months. And a lot of that increase has occurred, at least on the financing side, over the course of the last 60 to 90 days. How does that
home price inflation? Don't forget.
Right. So how does that? My point is, even if we see a correction in home values, you've still got this exponential growth that's occurred over the last 12 to 18 months. How does that not correspond to a conversation with that renter 12 months from now, after multifamily rent rolls have been marked to market, where that alternative of leaving that apartment unit and buying that single family home, that math equation is still extraordinarily difficult. And as a result of that, continues to sustain the demand that we see today, albeit not at the rates that we're seeing. But is there an argument to be had that the growth that we see after this mark to market, of this historic growth that we've seen, we should be running models out at numbers that are beyond that 2 to 3.5%, 2 to 4% growth stat that you referenced earlier in the call? Because I think some of the sell-off in the public REITs is an arm wrestling match about what growth looks like after the comps, from 2021 dissipate and the growth normalizes. It's a question about where do we normalize to?
And I think if it wasn't for the significant inflation in all input costs and the cost of carry, and many investors that own multiple properties, homeowners that have second homes, co-primary, we've got, obviously wage growth, but the reality is that, is there sustainability of these investors that are willing to take on all of the burden? And do we start to see, like, if you look at inventories, just in the March data, inventories rose sequentially 10%, although they were still down year over year in the existing home market 10%, which was the least decline that we've seen. But that doesn't tell the story, because the velocity is really the story, the velocity of what's turning. So people don't see the new listings because of what's coming on the market. Half of it's turning when historically maybe a quarter of it turned. And so we're seeing tremendous velocity. And the question is, if we start to see that velocity diminish, and there's more investors that have been a big part of the market, that just this inflationary pressure they're feeling, and it's across every aspect of the market, that might start to reduce the return profile, and we might see more inventory in the market that needs to be digested, and there might be pricing pressure. And I think there are going to be markets, nationally, the picture doesn't look as bleak, as there are some markets where there's been just a bigger prevalence of investors. And we do think about institutional investors that might have more staying power, but it's the private investors that I think are the ones that might not be able to handle the inflationary burden of all the input costs that are rising at double-digit paces, and any repair work, it's very challenging. So those are the things that 2 to 4%, whether that's sustainable or not, I think in your scenario is so contingent on how much of the individual investor was expecting to rent out those homes, and whether or not we now start to see them capitulating on being willing just to retain the tenants that they have, or Airbnb units. But, it goes back ultimately whether you have, a soft landing or not. I think that's what we really need to say is, like, if you're in a soft landing scenario and people are comfortable, then you probably don't have the risk associated with some of the things that I just.
There's no soft landing here. It's an impossibility.
All right, hang on, Aaron. I want to ask you a specific question to that. No, it's all good. It's all good. No, I'm going to go right to that. I want to hear your thoughts on this. So there is no soft landing. Okay, a pretty declaratory statement. Here's the thing: between 2016 and 2018, the 10-year rose from 1.6% to 3.5%, and during that same 2-year period, as the 10-year went from 1.6 to 3.5, multifamily cap rates compressed from 5.6 to 5.5. Okay. Now, in the backdrop of all that, the Fed was also unwinding its balance sheet, albeit over that 2-year period, only $800 billion. And the plan right now is to be doing about $1 trillion a year once they really start unwinding it. But given that backdrop of 16 to 18, we have to some degree been to this rodeo before. Now, poke holes in what I just said.
Inflation.
Yeah.
No, you didn't have inflation.
Inflation.
The generational shift. I mean, we've never seen inflation, and I don't think, we're certainly Kris, Mr. 42-year-old in a few weeks. I mean, 40 years ago, we had inflation, which is not therefore the same thing as what we just described in 16 to 18. The Fed has got substantial challenges.
But Ivy, the issue with it, I got the Fed's got substantial issues, but they're raising rates to fight that inflationary pressure.
Yeah, but
And we've also got wage growth behind all this that is unprecedented wage growth from clearly where we were in 16 to 18.
So
Aaron, go ahead.
So wage growth is inflationary. Number
Right.
one. Number two, inflation is at 8 and 8.3. I think the last CPI was, but I don't know anything that I do in my life that doesn't cost 15 to 20% more than it did 2 years ago. So I can't name a thing, and most people I talk to can't, whether it's buying eggs at the grocery store, milk, wherever. I was in an event 2 weeks ago, charity event. They bought 1 million eggs last April. And this food donor, and they said they paid $1.03 a dozen last April, and this year they bought 1 million eggs and they paid $1.40 a dozen. So that's close to 40%.
I love the fact that the only way Aaron knows how much eggs cost are from a charity event.
Listen, I don't know where they're getting it. I don't know where they're getting it.
I'm not going to put you on the spot and ask you how much a gallon of milk costs today or a loaf of bread, but I do.
I want to keep going down
there.
Aaron, keep going, because what I'm trying to get at is this. You say declaratorily there is no soft landing. And whether it's a hard landing or whether it's a soft landing, to some degree, we've been to this rodeo before. You and Ivy both point out, not in a inflationary / hyperinflationary environment. But what I'm trying to get at a little bit is the capital markets. I'm trying to get at, we've watched the capital markets in the last month move in ways that we have not seen in a very long period of time. We at Walker and Dunlop have continued to process a huge amount of business during that time. And I guess what I'm trying to get at is, if the Fed can be as transparent as possible about what it is going to do in unwinding its balance sheet and raising rates, is that not a market that actually functions as we go through this transition?
So, I mean, you have it two ways. You have a supply side inflationary environment with supply chain disruptions coming out of China. Which you have a food issue with Ukraine and all the grain they produce. You have no clarity whatsoever on what the Chinese government's going to do at all, or when they will do it. Nobody would have thought that international travel this time last year would still be banned there. You have tremendous wage growth, okay, and then you have huge CPI increases, and we're bringing rates. We're at a quarter point today. Like, we may be at 75 at the end of the day on the federal funds rate. We may be at 100 by the end of the day. They're going to go somewhere between 50 and 75. But like, people that, very intelligent people that understand inflation would tell you that to control it today, the rates need to be 7 or 8%. So what you could wind up in a situation is, rates kind of stabilize on the fixed rate side. They raise rates, wages stay hot, home affordability goes down. The cost to construct is up. I haven't seen a development budget. We have multiple $6, $7, $8 billion development projects ongoing in down in South Florida, in New York. We have one in California. every one of those jobs, we've seen 15 to 20% budget busts on the hard costs, labor, materials. You're talking about you're talking about lack of immigration, so workers on the construction side are not available. So you're talking about a scenario where you have people buying less, not able to build, right, because the costs are so high. But then you have crazy wage growth, so people can still bid up rentals, right? And that's like so you can deal with the rates where they are because you have this crazy rent growth that's going to stay in place. And you could see that across the gamut, and you could see that in any asset class, any hard asset class, which is really the bid, in my opinion, for hard assets. And that it's the difficulty to develop and build is going to get worse and worse. It's going to become more expensive for maybe less end users, but at the end of the day, that those end users go somewhere, and they're going to get bled out through inflation, and the Fed is not going to be able to raise rates or crack it hard enough unless they bury the market, in which place you have a hard landing, or you don't have a landing, which is still a really hard landing. So they boxed themselves in. They totally messed this up a year and a half ago. There's been a couple really smart people that I watch on Bloomberg or CNBC in the morning that have been talking about this for close to 2 years. I've made bets in my personal account on this that have worked out phenomenally. And I don't know, I don't see any way around it.
So Ivy, one of the things that Aaron just said was rent growth stays. So I hear that and I say the market has missed the opportunity in the multifamily REIT space because they've got extremely high occupancy numbers. And if all the factors that Aaron just talked about people not being able to build new inventory, and there's this huge gap between single family and multifamily, that renter base stays, you continue to be able to push rents, and being in multifamily is still a good place to be. What am I missing?
Well, I think that we've had a lot of government support for renters, whether we're talking Class B, Axiometric does show delinquencies across 49 and 50 states are rising. They may not be at the elevated levels, let's say in California, that EQR and Essex pointed out, but I think that we've had so much liquidity pumped into the system. I don't think wage growth can keep up with the rent inflation we're seeing. And there could be a lot of broken deals, to Aaron's point, where there's just development. You have to monetize that development. It costs money to carry those projects. So they're going to continue to move forward so they can pay back their costs of their debt. So I don't know that you'll just see projects that get stalled. Those projects might not get delivered. Kris and I have a bet how much the completions will be in 22 versus if it gets pushed out to 23, and he might be right, but they're not just going to sit there. They're going to get delivered. And
so let's talk about that. Sorry to interrupt.
Well, no, I don't want to take your bet.
Go finish. But let's come back to that. Let's come back to that.
So I want to hear the over under on the delivery. I want to hear the over under on the delivery. I don't think it
really matters, though. I don't think it matters because
how does it not matter?
How does it not matter?
It doesn't matter because if you're a developer, you've started those projects. You've got costs already incurred from the economic incentive. You want to get your money back. So there's going to be pressure, whether they are feeling it as an operator, as a developer, that's going to come from somewhere that will maybe affect a different project that they have. So there's, they have portfolios. So if there's backlog that doesn't get delivered, it doesn't mean that they're sitting there in good position. If their development costs are, they continue to have to keep moving forward. That's one thing about our builders, just in general, developers, they will monetize. They will go forward. They will go vertical. They will not just leave projects in the ground. And that's what we saw in the last cycle. And I'm not going to say the GFC is what we're expecting. I'm just saying that monetization is going to happen. At what price and at what return is the question for you.
The monetization will occur, and it will occur when the deeply equitized project, when the LPs on that project decide that they want to monetize.
But they're just going to be happy. They're just going to be happy carrying.
Are totally different than they were 14 years ago. It's not even worth comparing. And so, like when you talk about what the different products and what that's going to impact, my position is, so for the record, so Ivy thinks 415,000 deliveries this year. Is that right?
For completions, 400.
Yeah, completions.
Yep.
So to put that in perspective, we absorbed 550,000 units in 2021, 350,000 of which were in non-gateway markets, 200,000 were in gateway markets. I think that her number could be 40 to 50,000 units high. And I justify that by conversations with our development partners and clients who entered January 1st saying, how do I go double my pipeline this year? And we're 4.5 months, we're 5 months into the year. And the conversation has gone from how do I double my pipeline to how do I execute what I have in the ground right now? How do I help my contractor figure out how to procure material? How do I find offsite storage to warehouse inventory? Because the supply chains that were broken in November when we were on this call are only more broken today. So I think what that manifests itself in is a focus from the development community towards execution. And I think that actually starts in 23 and 24. So
as it should, but you also keep in mind, we think of shelter holistically. And so recognizing that land values have just been surging. And a lot of the land values have been surging because you've got multiple types of developers, whether they're multifamily, you're looking at the build for rent capital, the for sale builders. You know, we have lot inflation that's been, you know, up more than 30-40%. Some markets it's double. And so to pencil those returns, especially the newer capital that's not necessarily familiar with cycles, it may be very difficult for them to continue. And there might be broken deals where there'll be some pressure because they're going to try to exit. And that's one of the things that we have to just be thoughtful about, like how much of what's in the backlog starts to trade even in the midst of development.
Have you seen a shift, Ivy, between the home builders that you're covering optioning lots versus taking them on balance sheet and what would that do?
No, they absolutely have. I mean, they actually, this quarter was the first quarter that they slowed. Sequentially, it's still increased, but they started to, you know, have a little bit more tempered pace of how many lots they're adding. So I think, you know, lots that are, you know, year over year are still growing 25-30%. But I think that the public builders that account for almost 50% of the market are definitely more prudent, and there's definitely more optioning. But there's, you know, a lot of capital that within those options that could become where they walk away and abandon them. But I think the build for rent capital that has really been a predominant driver of the land inflation in these, you know, real growth markets, those are the operators that are it's what's been fueling the inflation. And so I think there's builders that have chosen the for sale builders to take advantage of, you know, what could be a very good counter-cyclical avenue for them to mitigate the risk of affordability on for sale. But it's all interconnected. That's what I want to make sure we understand. And if it wasn't for our contrarian view that we are currently not overbuilt right now, but that we don't have the deficit that many think we do, I think that we would be a different discussion. So what I concern myself with is that households today, because of affordability being so challenged, and whether it's, you know, the stock market and various asset classes that are now going to be pressured, do we start to see household consolidation, people multi-generational living again? And that has already been a factor where we've had that, you know, 20 to 39-year-old that's been living at home, you know, puzzling longer. So because we can't afford to go buy, or you can't afford to rent because the rents are too expensive and people are being priced out of the market. Those are things to be, I think, just thoughtful about. If it wasn't for all this production in the backlog that we know is coming, you know, again, we've got several 100,000 units that are started but not sold. And that doesn't incorporate the other, you know, 150,000 units that are authorized but yet to be started. You know, we've got 800,000 units in backlog. A lot of it's highly concentrated, and a lot of it is in the tertiary markets, way out there. So that's because that's where the land values were the most compelling.
There's a segment of the market that has issues.
Hang on a second, Aaron, I want to come to you on that one because Ivy just said a lot of it's in these tertiary outstanding markets. That gets to back to office. So you're doing a bunch of office financing in your in both Manhattan as well as across the country. One of the things is we've been looking at, we've talked a bunch about the multifamily REITs. What quite honestly gets me scratching my head a little bit, it's an incredible company and Owen Thomas does an incredible job of running it. But the fact that Boston Properties is up right now, given what's going on in the office space, quite honestly, kind of makes me scratch my head. I realize that most people are signing and going for A-class properties, and therefore that plays directly into Boston Properties and the types of buildings that they operate. But what's your take on the office market, Aaron, and the fact that, I mean, I just saw a graph that was sent to me yesterday as it relates to back to office. The Austin market is kind of leading the pack at about 55%. But we have clearly not gotten to what Peter Linneman said would be a tipping point once you get over 60% back in the office. How hard is it to finance an office building right now, given where we are on back to office?
Yeah, listen, I think it depends on the nature of the collateral. So look, new buildings, really well located, or even slightly off the beaten path, but new, there is liquidity for them. And we are seeing those buildings lease. We're not necessarily seeing them lease on a pre-let basis right now, unless they're a 1 million square foot plus tower where you really need an anchor tenant to drive the capital markets to capitalize that transaction. But we are seeing a flurry of activity in new buildings. We're seeing activity in older, what I would say vintage Class A assets, which aren't really A buildings anymore, where there's just been a tremendous amount of capital dumped into those buildings to revitalize them, to amenitize them. And we've seen those buildings attract tenancy also. We have not seen like the value leaser go out there and say, I'm going to go rent in this B building because, the rent is really cheap. We've seen that company maybe leave the marketplace. Or just do a Band-Aid lease. There's lots and lots of these 1 and 2 year rollover leases in buildings that are just continuing to go, on and on. But new product, there's demand for. There's leasing demand. I believe there's capital market activity demand for. Look, the truth, and look, I had lunch with a very, very large office landlord last week. We were talking about this. He said, look, companies have to have space. Like you can't, if you have a 300 person company, or 200 person company, or 100 person company, to sit there and say that you don't have office space, because it's just it's not possible. So even if you only have 5 or 10 people in your office, or you're in the office, and what I think the new work week pretty much in the office is, based on what I see in the streets of Manhattan, is a Tuesday to Thursday work week, where Monday it's very, very empty here. Tuesday, Wednesday, Thursday, it's much more lively, not like it was pre-pandemic, but it's much more active. And then Fridays, there's nobody here. And I think that's the new work week. But if that's the new work week in the office, you have to have office space. Now, there's some companies that will downsize. Some companies go into some sort of hoteling concept. No employee likes that. So employers need to be mindful of what their employees like. If they want them in the office, they better be providing a space that person is comfortable going to every day and is going to be efficient in and feels good about entering that building.
So you mentioned earlier, Aaron, that urban infill hospitality is something that you're seeing. So are you seeing lenders or equity providers excited to go into that space right now, given the fact that, first of all, finding a seat on an airplane in the United States right now is pretty darn difficult.
It's touch and go.
Yep.
The resort properties around the U.S. have seen their EBITDA double, if not triple, from 2019 to today. And there's been tremendous capital market activity for them. And the pricing of those loans has come down substantially from where they were 2 or 3 years ago. The urban infill hotel story is a different story. It's about basis per key, price per foot, type of asset, who the asset is trying to attract. We have a couple of select service, what I would say 3.5, 4-star-ish type properties in New York that, got killed during Omicron, but before that, we're doing very well in the fall, and now their forward bookings are fantastic. So we're seeing those numbers on those assets, proving out, our thesis, and you can buy those hotels at 30 or 40% less than you could pre-pandemic potentially. So that's why we think there's such a great investment thesis, and we're seeing that with still a business traveler that's 30% of the way back and little to no international travel. So we were very bullish on those assets, but the capital markets are, they're very, very selective.
Right.
And I'd say the price of money for an urban infill hotel versus a resort property that's seeing tremendous NOI growth or EBITDA growth, that spread is probably, a low mid 300-ish credit spread to 375 to, in the urban infill areas. That money got into the fours. I think that's now out into the fives again, into the low fives with this capital market disruption that we've seen.
So Kris, as you look at capital flows into multi right now, and given the underlying fundamentals of multi, which we've kind of both poked holes in and also seen some real signs of optimism, if you will, as it relates to new supply, as it relates to rent growth, things of that nature. Two questions. One, are you seeing any new capital arrive? So for instance, in Q1, the B REIT, Blackstone's B REIT, I believe raised $7.8 billion. Starwood's S REIT raised $2 billion. So we're still seeing inflows into those vehicles. I believe the number at the beginning of the year from Preqin was there was $288 billion of dry powder in US private equity firms looking at commercial real estate. Has the bidder list changed, Kris? Are you seeing new foreign capital or domestic capital showing up, going after multifamily assets?
We have seen, it's somewhat anecdotal, but we did see in the fourth quarter some direct foreign investment, not through domestic advisors, from Germany and Korea into large single assets that we were marketing in DC and South Florida. So that seems to be, kind of in the early innings of the trend. I would say, Willie, that the cast of characters and the capital that's been formed for multi is largely known, but what we are seeing is we're just seeing a continuation of that kind of market rotation. And so we're seeing, market participants that were, typically on the West Coast, they're focused on, kind of core gateway assets in the Northeast. That rotational trade that we have been observing for the last 6, 9, 12 months is very much, still in process, and it has changed the complexion of the bid sheets that we've seen. Really, kind of largely, that's kind of a Sunbelt oriented conversation.
So I'm tight on time here as we wind this up. I've got to go back to the three of you and get you for your where you're going to put your $100 million right now. And as you know, I'm gonna hold you to it when we get back together 6 or 7 months from now. So Ivy, let me start with you. Last time it was going after, if you will, the single family fixer upper market. Are you still in the fixer upper market, or have you shifted to another part of the landscape?
I think cash is king right now, even though that sounds counterintuitive given inflation, but I'm concerned about, right now what we're seeing in the dislocation in the equity markets and the risks associated with pressure. There might be some select markets where the land is constrained that I'd still do repair and remodel, and fixer uppers where the supply is very, very tight and there's not a pipeline coming. But I'd probably say I would more shift to cash and still going with that strategy.
And waiting for what to happen to deploy that cash?
For opportunities, being opportunistic with respect to valuation, things that become very compelling, whether it be equities or thinking about hard assets, whether it be in the single family market. But right now, I'd say that a lot of the migration states where we've seen just very excessive home price inflation are areas that I would be more concerned about, because that's where the capital has been chasing those markets. So, you could be more bullish in areas where the consumer today is still present and alive and well in the Midwest and certain parts of, I guess, more affordable, less desirable. But I think that the supply prevalence and even, it's interesting, like California right now is seeing a strong activity inland as Florida. I mean, maybe the price appreciation is not as great, or Austin or Phoenix, but it's really across the board what we're seeing with so much of the liquidity that's been pumped into the market. So I think it would be a pause and let's just reevaluate.
Aaron, where are you putting your money?
First off, I agree with Ivy's assessment on, I want to say, on the housing market. I do think that supply could come down, construction costs being so high, which would tamper the downturn we're going to see. But I do think that the single family housing market has real fundamental issues. We haven't seen that yet in multifamily. As far as capital, I'll go with Bitcoin again. I think it
Dollar cost average.
I don't
Dollar
think-
cost average back up to where you were
I don't
last
think
time.
I don't think the Fed is going to be able to fight inflation and have the will to fight it. Ultimately, the way it's going to need to get fought, and I do think that governmental currencies around the globe are under duress, and I do think at some point Bitcoin will disconnect from being a high beta growth asset in the Nasdaq and continue to get adopted. I wasn't a believer in it originally, and I'm still somewhat skittish, but I'm definitely very much so invested in it because I just think that it's an inevitability, and I'd also invest heavily in the energy businesses right now, whether it's pipelines, drilling companies, wherever else. We are drastically undersupplied in oil. There's been no CapEx spending in the last 8 years at all in the space. And there is just tremendous cash flow opportunities there. And I don't see that really in any other sector.
Mikkelsen?
So I got this for Ivy. I got some notes on how we kind of mixed it up on our last webcast. So I was actually going to put this on before we started debating the supply and demand, her take on overbuilding. So I didn't. So maybe the first thing I'm going to do is I'm going to get self-defense lessons for the next 6 to 7 months when we get together. So I'm prepared to take on some of Ivy's contrarian views. I think it's a time to de-risk, and it's a time to have a flight to quality. I think it's a time to focus on high growth in migration markets and the best quality assets within those markets. Those are proving to be the most resilient. We're consistently pricing those assets today, kind of at expectations, at guidance. And I think it's a reflection of, frankly, some of the smartest institutional capital in the market, really understanding the resiliency that those assets offer. I think that, some of this decoupling of risk and the risk parity trade that we talked about a little bit is real. And I think it's hard to kind of figure out exactly where the bottom is for some of these assets that got overinflated because of, everything that we've been talking about for the last 60 minutes. So I'm buying core multifamily in the Sun Belt, and I guess the last thing that I would say on the support for that thesis is I think the cost inflation pressures that we're seeing are not going to subside over the next 6 to 7 months. I think the lion's share of the developer sponsors that we work with would tell you costs have inflated 25 to 30% over the last 12 months. That's accelerated in the last 6 months. I think that acceleration is going to continue. I think that picture is going to continue to be really challenging. And, not to put my geopolitical hat on, but, what happens to inflation if Russia decides to cut off the natural gas pipelines to Germany? Things like that, these kind of additional geopolitical kind of black swan things that could put additional pressure on inflation, I think are real. And I think it's time to de-risk away from that.
I was just going to ask you, Willy.
Last thing, because I gotta wind it
What
up.
about you? We want to know what you're going to do.
That's a good
God,
question.
what about me? I'm
Yeah, where are
obviously-
you investing?
Share buybacks.
I'm
Yeah.
continuing to invest in the three of you and the businesses that you all run. And to be honest with you, Ivy, at these times, this is when investors need Walker and Dunlop more than ever. They got to be able to call up an Aaron Appel or a Kris Mikkelsen and have them guide through what they're going to do. Because at the end of the day, as much as there's lots of scary stuff out there, people are going to continue to invest in hard assets. And we happen to be, 80% multi and 20% non-multi. And so we're in a really good asset class right now. And I think that the core market, albeit with lots of challenges around it, is still a great place to be. So I got to call it a day. As always, the three of you insightful. Love the banter. Thank you all. To everyone who joined us today, thanks very much. I've got Goldman Sachs's chief credit strategist coming on next week to talk in more detail about a lot of the issues that we talked about today. Take a look at what the FOMC does today and where the market stand a week from today. So hope to see everyone back next week. Thanks for joining us. Ivy, Aaron, Kris, thanks very much. See you soon.
Take care.